Hey guys, welcome back to, what is it, Vlad? Sixth,
Six.
episode 6. That's incredible. Here we are again back with the Silly Balls. And today is a very special episode, the first episode, hopefully of many, when we invite one of our friends, one of our fellow investors to chip into the conversation. And today, for today's topic, we decided to invite our good friend Hector, alias About Trading on eToro. Go check him out. Today we're going to talk about behavioral finance and biases and emotions, especially in days like this when, if you look out there, if you see in any kind of news in the last couple of weeks in the markets, you know that there is lots of uncertainty, emotions are running high, and what we can see from our feeds and our conversations from our followers, with our followers and copiers on eToro, a lot of decisions are being made based on these kind of biases and emotions. And because I remember Hector and I, and actually all of us, this little bunch, had lots of conversations about the nature of these biases, and Hector really dig deep into understanding the differences and how these biases work. That's why it's great to have him on board today. So with this, I pass it on to him and fire away the first question. What is the number one bias that you see out there, especially when we're going through eToro feeds, reading other comments or other expressions from fellow investors? So what's the number one way you see it?
Yeah, so one fun thing I'm seeing in eToro feed is a lot of people are calling the bottom in March because they remember the 2020 bottom, and they also remember when in 2021 we had the Trump drone thing with the general in Iran. So they remember that the effects of these conflicts ended really fast. Everybody remember that the COVID was just a glimpse in the chart. Then it just started skyrocketing, and people just want to make money. So they are all buying the dip without actually thinking about how long these things will last. I've seen the other day, for example, the Putin announcement that the dealings with Ukraine were going better, and we've seen like the GER30 going up 2.3% in a few minutes, and that made no sense because like 30 minutes prior he was saying that he was just asking for new volunteers from the
From Syria,
from the
yeah.
Eurasian countries to fight in Ukraine. So yeah, where's the progress in that? So this is called the gambler's fallacy. So you try to see patterns where there are actually no patterns based on prior information you have. And I don't want to touch about day trading, but that's also a place where we can see that. And the eToro feed is actually full of these kind of people that are luring others to take decisions. And I see even the comments. So somebody is asking, what should I do? Should I sell this position? Should I enter into it? And there's people behind in the below in the comments saying like, yeah, you should do it because this is the bottom. March was the bottom in 2020. So just go invest everything you have. And this is bad advice because we should always remember that the best thing to do is just put our money and chip them slowly into the market, dollar cost average, and be consistent. That's the only thing we can do. That's all the info we have. All the research, all the papers are saying that this is what we can do. So yeah, the biggest I'm seeing right now is certainly the gambler's fallacy.
What I wanted to add instead is I think all three of us has how should I put this, mixed feelings towards Alibaba.
Agreed.
Yeah, and I clearly remember when I had this conversation. It was maybe with one of you or someone else from our little bunch that it was trading at 150 or 130 or something like that, and someone said, it shouldn't go any lower. That's the bottom.
It was probably me.
Maybe
it was probably me. Yeah.
But I think I was pretty quick to confirm and agree to you and say that yes, you're right. This must be the bottom. But then again, now it trades at what, 90?
Yeah, 86, around that.
Yeah, something like that. And yeah, anyway, this just was another example to that kind of bias that even for, and I think this is one of the most interesting stuff about not falling victim into these biases, is that even the three of us who are working quite actively to avoid any kind of biases, to remain attached to facts and logic all the time, are still sometimes prone to
Yeah,
look at things from
I
an
would
emotional
say
angle.
nobody is immune to biases. You just learn to acknowledge them and to understand when you are falling victim for a bias. And once you acknowledge that, you decide if, all right, am I actually victim of a bias or am I right? And of
All right.
course, that requires further analysis. In my opinion, for example, regarding Alibaba, I didn't think I was falling victim to an anchoring bias or anything else. However, reality sometimes can be against you. So if we have more risks, if we have a new conflict emerging, and then people being afraid of China doing the same with Taiwan or something else, then of course we will see all this uncertainty having an effect on the price. It doesn't necessarily mean that the quality of our analysis and our thought process was wrong. It's just that reality doesn't always unfold as we expected, and this is normal. And that's where risk management actually comes in. So this is our job. It's what we do when we manage our portfolio. We have to manage the risks accordingly. So yeah, I would say nobody is immune to biases, not
Yes,
even
but
PIs, not even Warren Buffett.
yes, but then there is also the reverse part of the medal, because you can also identify biases. I mean, one of actually Warren Buffett, or was it Ben Graham's quote, buy from the pessimist, sell to
and
the
sell to
optimist.
the optimist.
Exactly.
It was Ben Graham.
Okay, because you can also identify certain biases, and I'm gonna give my example because I think I'm really heavily invested into China, and I know that the sentiment towards China is bad. I don't expect it to revert overnight, but I also understand that these type of valuations, where the companies are sitting at the stocks, they're really low. They could go low. Of course, they can always go low. Gazprom was trading at $1 and it still fell to a few cents. It's still a -50 decline even from that bottom. But my idea is that you can identify this type of bias, in this case, like a negative bias. This is going down because investors have lost their confidence. But I'm gonna come with another quote now. I'm full of quotes today, also from Ben Graham, that said that Mr. Market is a schizophrenic in the short term, but will regain his sanity in the long term. And this, I mean, of course, in the meantime, the actual financial performance of China can change, of Chinese companies, and of the macroeconomic environment in China. That can change. There's always a big question mark. But chances are that the companies will still get back to their true value. So even if I'm buying now a certain position, let's say Alibaba, at $110 a share, which is already very cheap, it falls down to $50. I'm losing what? 60% of my position. Panic. No, a panic is only when I actually sell my shares. I'm gonna sell my shares to somebody that identified this bias. Unrealized profit is nothing. Only the realized profit or loss is what really matters. And if you are patient enough, your dollar cost averaging your positions, of course, you have to take into account that there is certain risks to this, but then you can play it on the long run. And then as long as you're composed and understand the macroeconomic environment, you're fine.
Yeah, you said two very smart things here. You used the word chances. So this is important because investing, after all, is always about probabilities. So we have to think in terms of probabilities. Nobody is certain about anything. So as you said, China may change their economic situation in 2 years from now. But in this exact moment, probabilities are that we made the right choice. And the second smart thing you said is that when somebody sells, there's somebody else on the other side buying. This is how the stock market works. So if I'm selling, why is there somebody on the other side willing to buy this? Is he stupid, or does he know something I don't know? Maybe he realized I'm biased and I'm panicking. So he's taking the opportunity to increase his holdings and benefit over the long run. And as you said, it doesn't matter if the investments go down. Monish Pabrai is famous for buying stocks and always seeing them go down by 60%. It's like his pattern. Every time he buys something, he sees his investments going down 60%. And then after a few years of patience, he usually gets a really good performance out of them. He started like this, making an equal weight portfolio of 10% in each stock. And over time, of course, he got more sophisticated. He met Warren Buffett, he learned more things, and he got more educated about the stock market. Yet, he showed that it doesn't matter how much you go down, as long as you are well aware of what's happening macroeconomically, what's happening with your specific company, and what you can expect in the future in terms of probabilities. One good way to think about this in rough numbers, because you can never be precise in the stock market and nobody is an omniscient machine knowing everything. You can use the Kelly criterion and assigning some different percentages to different scenarios. And then the Kelly criterion will tell you how much you should invest of your portfolio in those specific stocks. When running it with Alibaba and being very conservative, it actually says that you should invest more than 70% of your portfolio in Alibaba. Of course, you shouldn't do that, but it's a good indication of how confident you could be if you want to believe in your own analysis and your own scenario analysis for the future.
On this whole overarching bias topic, I just wanted to roll back to that part when you said that actually when we look into our own performance and our own decision making, there's always this sort of duality that do we act because of some sort of bias, or do we act because we have a rational decision rooted in facts and logic and the analysis that we conducted. So that's one way to become better investors, is that we constantly check back on ourselves and keeping ourselves in check, let's put it this way. But the other way is that I think as investors, we can benefit from behavioral finance and sentimental analysis, because these two things go hand in hand, is that when we try to identify situations when the market is acting based on biases, and one of these biases, a prime example to this bias, is what's going on with the Russian stocks right now. If you look at these companies, if I give you the balance sheet of any of these companies without telling you what sort of company it is, you're just looking at the numbers, looking at their revenues, the free cash flow, their operating expenses. So all the usual suspects of a balance sheet, but I cover out the company's name, and then you see those numbers for yourself. And then I told you the price at which they are trading right now. Most experienced investors would say, "What the f?" So what's going on? Do these businesses going to go out of business next year, or why are they trading at such huge discounts? And the answer is that they're trading at such a big discount because the market and the entire world hates them, and hate is an emotion, and as an emotion, it pretty much constitutes as a bias, right? So correct me if I'm wrong, but I always try to look at a company based on the balance sheet, looking at what sort of money they take in, what they pay out, what profit is left over, what sort of dividend they pay for the investors, classic investment stuff. And I can't help myself, and it couldn't help myself when I was at that position, to see Lukoil going down from 80 something to 50, and then to 30, and then to 10, and then to, we all know the story.
0.5.
0.5 or whatever. But the thing is, and that's why I try to communicate in every single channel, every single conversation I have with fellow investors or with copiers or whoever, to look at the balance sheet of Lukoil. If you look at their assets, and we are talking about physical existing assets and reserves and areas that they can drill and get the oil out. And again, this is not a conversation about the moral side of the story. So, and I think it was we had this conversation between us a couple of days ago that they could buy themselves back with 2 days worth of revenue. So if the company takes in money for 2 days, they go to the open market and buys themselves back and go private on 2 days share price.
Yeah.
And these are the things that
Also, if it doesn't happen, at some point, when this conflict will be over and people will start forgetting about it as we forgot about Afghanistan and everything, at some point, some opportunists will chip in. And sometimes the trading is not executed by people with ethics and morals. Sometimes it's algo trading. So at some point, algos will start pumping the prices of these companies. So being in might be advantageous for an investor if he managed to control the risk and knows what he's actually doing. So yeah, I do agree with you here. It all boils down to the efficiency of the market. So we have to intervene when the market is inefficient, because it's the participants that make the market efficient. So this is our job, this is our role. We don't have to be emotional.
Exactly. I mean, imagine if I was in that position and brought Lukoil, because I think Lukoil was a good example. I said, you know, let's say I am the owner of Lukoil, and I go to you and say, hey, buddy, I have a company that pumps shitloads of oil. I'm not sure what percentage of the Russian oil output is down to Lukoil, but anyway, quite huge. And I walk up to you and say, you can take it for $3 million, and you go like, this is fucking inefficient. I take it.
Yeah.
Like,
give me.
I think if you look back, we can apply this to not only to Russian companies, but all sorts of other asset classes or sectors or countries. China, we earlier touched base on, and we know what an incredible bias goes around Chinese companies or China as a country or whatever. Fossil fuels, as you all know, I'm the one from the bunch who's into
drinks
that.
Oil.
Drinks oil, yeah. But also just we had this conversation a couple of months ago about shipping and the shipping sector, and that brings up another interesting bias from the many that is out there, is that the shipping sector was one that basically ripped investors badly in the last 10-15 years. It wasn't a sector you wanted to be in, and I think many investors, whoever touched any of these stocks, still has this memory of losing money on them. And because of that, they're not touching these stocks again, because they think they are biased that they're going to lose money again, right? So this. I think we all can bring up examples.
We could say again, it's the gambler's fallacy or the anchoring, or it can be different biases. But yeah, they basically were sticking to the past. We're seeing patterns where these patterns were not there. And they didn't actually see that the shipping industry was reborning thanks to the COVID and the new ships arriving, finally being able to use them, all these investments finally paying off, and all the cycle finally culminating at a point where we could finally take some profits. And I remember Levente contacting me and telling me, what do you think about Zim? I found this company and it's like huge. I love it. And I looked into it and I said, how the fuck did I not find it before? Like it's beautiful. It's the best company probably you can buy right now. And I used to hate the shipping industry too. So I was biased in this sense towards the shipping industry. And I remember that it's thanks to you and your data points that I actually could get out of my bias and actually think rationally about these companies.
All right, guys, I think we are closing to an end here. We said a lot of stuff about biases, different types of biases. How can we as investors avoid them or take advantage of them if we see that the market is just inefficient or biasing itself into a position that we can take advantage of, whatever. So is there anything else left in you that you think could add to the topic of behavioral finance?
Not for me. And guys, if you think that we missed anything, just go down in the comments, and then we're more than happy to continue the conversation there. Hector, thank you so much for joining us today.
Thank you for hosting
me.
me.
Pleasure. Yeah, guys, you know the drill. Like, subscribe, comment, and see you next week.
Thank you, guys.
Hey, everyone.
Bye.
Take it easy. Bye now. Right?
Yeah, this is a good way to chip in.
No, it was already it.
Okay.
Absolutely, and it didn't start the sentence.